Now we're going to pivot to the U.S. and obviously, I'm sure by this point everybody knows that the Fed increased rates. They went to that 5.5%, and it was very well telegraphed. The hike was 25 basis points, bringing the Fed funds rate to the highest since the beginning of 2001 in terms of the upper bound shown here. So it's not surprising. One of the things that we think is going to be a bigger issue is because gasoline has moved back to that 8-month high, you're actually getting some of those flexible inflation numbers rallying once again. And that's going to put a damper on some of the inflation expectations because this started in July, and realistically it's going to carry over into August. And that's going to put a lot of pressure in terms of where things are. The dollar, as we were saying, it bounced. We were saying that since January, it's been between, the DXY index is going to be what I'm going to reference, between 100 and 103. It broke 100. We were saying this is foolish, like it should be bouncing. And here it's back to about 101.58, right in kind of the midst of where things are. So we don't really see a huge adjustment. We do see one more increase, and we want to talk about why. And why we think that's likely the case. We do think the next report, the next meeting will likely be a pause. But it was interesting because when you looked at the commentary, it was a unanimous decision to raise rates again, and they did leave the door open for more policy rate hikes. So I do think there is that one more. The ANZ, which is just a company research, the adjusted Taylor rule implies 5.5%. When we look at it, it's a bit higher. When you use the Fed one, it's a bit higher. And as we've been saying, it's probably closer to 6.5%, 7%. We don't see it obviously getting there, but it does support a bit more of an activity and a bit more of a push to really try to get in front of some of the problems that have continued to come through, and to try to find a way to just bring down their balance sheet. So total assets on Fed's balance sheet now through the low prior to the banking stress in March, and it's the lowest since the fall of 2021. And for those that remember, during Bernanke, they wanted to bring it back below 1 trillion. So we're currently at 8.275. So to give you an idea of how far away from that 1 trillion we are. The Fed discount window is stabilized, but you could still see it's being used fairly aggressively, which is not something that it's not a concern, but it's also not a good thing. So we want to just, again, keep track of that because this will help kind of monitor what kind of stress is out there, especially when you start looking at the banking side and some of those key pieces. Now, when you look at GDP nominal piece at 6.3% year on year, nominal GDP growth was quite strong relative to the post Great Financial Crisis, but not a consistent. And it's not really a consistent recession tell. And that's where you get some of the positive news in some of this in general, because there have been times of much stronger growth within a recession, but there's also been times of weaker growth with no recession. So when you look at the GDP front through Q2, you get an idea that things aren't terrible, and that's accurate. Obviously we're in July, we're past that Q2 component. And the reason why we talk about that is because when you break down the components, the consumer spending, which is obviously 70% or so of GDP, was still positive, but you see the deceleration. And our commentary has been that Q3 saw an accelerated downside or an accelerated deceleration and likely negative starting now. It's not that it was negative, for those that have been following us, we said, look, March was the peak and it was only going to be down from there. And you've seen that come through. And I guess people misinterpreted what we were saying and saying that it was now negative. It's like, no, it's negative growth, and it could still be positive, but you're moving quite rapidly to the downside. And that's what we've seen here. Net exports services, again, fairly flat. Government spending slowed down, but again, that was a lot of the expiring capacity on different policies. You'll get another one with the end of the moratorium on school loans. And then when you look at fixed investment, this is a bit lumpy. And you could see that when you look at fixed investment, it was negative for a period of time. it can only be negative for so long, and that's why typically you'll get spikes, because you have to do some sort of investment. You have to maintain these assets, so you'll get a spike and then it'll fade. And here is where we had one of them, and then the change in private inventories. Here you can see that that's been fairly flat, and you'll likely see that get down in general. So then when we go a bit further, the U.S. personal consumption, you get an idea of where some of this is moving. Second quarter of personal consumption was 1.6% quarter over quarter annualized versus the estimate of 1.2. 4.2 in the previous, so slightly better than expected. But again, you see that drop to the downside, which we think is going to continue. Industries with the most distressed debt, which is something that we've been highlighting, is obviously real estate. Real estate continues to be a big overhang. And that's why when you look at the amount of exposure from private equity, from small banks, larger banks, that's where we continue to see some of these underlying issues, with leveraged loan index default rates starting to rise a bit. And a lot of real estate had these leveraged loans, but there's other loans out there, or at least projects that were sanctioned or at least were thought to be positive because of ZIRP or zero interest rate policy, that are no longer viable. So it's even worse if you think about growth or expansion, where those essentially those things will never come to fruition, and you have to factor in, it's like, okay, well, and then how much of it is going to have to be restructured or will just go sideways? And the reason why is because when you look at that, bank funding costs will likely remain a headwind, because bank funding costs and the cumulative change is becoming a bit more difficult, which means that they're going to be less likely or unable to give out those loans in such a way, limiting some of those underlying structures. And then it's interesting because the private structure investment, you've seen some of those increases on the manufacturing side, but it's important to understand percentage-wise, because manufacturing structures are only 9% of structures and 2% of total investment. So it's good. It's not, obviously it's positive, but you have to understand, okay, well, what does that really mean? And then other areas are negative and in contraction, but slightly. You're not getting this huge drop. But the biggest area that we obviously see opportunity is power. Not only just on the power front, but also transmission and wireline, because we do have a lot of FDI. We do have a lot of things coming through that are going to be a much bigger, I think, opportunity as we go forward. The Fed recession gauge is near a 40-year high, and this is just looking at the New York Fed one. So again, we're going to start looking at good and bad now. So this is just one gauge. Obviously, there's a lot of gauges out there. We're going to show you the bad ones as well as the good ones, just to give it the full picture. And the bifurcation, because they're looking at different things and different inputs at different points in time. So it's important to weigh them together, and what they all kind of come out to is just blah, like not real growth, not real decline. And then the U.S. market implied change in the overnight rate, as you can see, going into September and November, you're still seeing a bit of those increases still kind of remaining as a factor when you look at the chances. And I think it's going to be important to see how that changes over the next few weeks with more data coming out. 2Q 2023 core PCE index was at 3.8% versus the estimate of 4%. GDP price index came in at 2.2% versus the estimate of 3%. Again, so you got some of this reversal, but when you look at the top left, you can see that even though it came down to 3.8%, that's still ridiculously high going back to 1990. So it's important to put that into context as terms of where we are. And then the U.S. GDP price index coming in pretty close to where things sit. And just kind of where we are, where we sit in terms of those levels coming into that normalized piece. But it's important to look at, okay, well, what happens next and how is that going to go? Because so far in Q3, we've actually had a little bit of a bump, and that's going to be important because during Q2, you had some pretty sizable declines in flexible inflation, where you still had the sticky issue, but flexible went and just nosedived. And that started to kind of, let's say, curl higher in June. And that's going to be an important piece because then we saw that acceleration in July. And we do expect to see at least August start out strong. And that's where we could see some of this reversing. And that's where the Fed could say, well, maybe this is something that we have to try to get in front of. We have to let some of this play out. So that's where we see a little bit more of that pressure point, which is going to be an important one to watch. Now on the conference board, U.S. leading index, it was negative again, came in at 8.1%. The net contributions for it were new orders were negative, which again we've been talking about. Consumer expectations, interest rate spreads, interest rates going back. But when you look at stock prices, it's strong as strong is. Building permits negative, jobless claims again. So outside of stock prices, and again, there's two things that we're going to talk about. There's the stock market and the economy, and you can see a bit of the bifurcation between the two. Now, on the negative side, when you're looking at interest rates and mortgage rates and, again, sticky inflation, this just kind of puts into perspective some of the key places here with housing prices actually pivoting back up, and that's going to keep wages going up, wages pressed higher, and that's going to again, put a pause or a little bit of a damper in terms of what does the Fed see? What are some of the pressure points as wages continue to trend up? Now, coming full circle to what we were talking about with sales, retail sales tracked by Johnson Redbook are down 0.4% year on year in the most recent week, excluding the COVID drop, obviously the worst annual drop since 2009. And you can see it takes time to see that work through. But as credit card rates have just absolutely been gunned and all these pressure points go up, that takes, and now we're starting to see that actually draw down and bring negative the consumer on that front. Credit spreads increasingly disconnected from the economy. Not surprising, bankruptcy filings are at odds with subdued credit spreads, but then when you look at the offerings, like the 7-year just came out. And for those that don't know how offerings go, there's a when issued. So a when issued is looking at what the market expects the yield to be, and then it'll either go through the tail or it'll kind of come in right on point. And we keep seeing yields slip higher than what the expectation is, which means that the auction wasn't as good as it could have been, and in order to clear the auction, you had to bump yields up, which means that prices came down. And that's an important one to watch because that's showing that people are a bit concerned, and you're obviously not seeing it in the market right now, but that's something to watch when you look at some of the pressure points, especially as bankruptcies continue to surge. When you look at the first half of the year versus the second, so far 2023 is right at where we essentially the full year was for 21 and 22. And as we see more rates and the inability to roll some of that data, some of those bonds, it'll be an interesting one to watch. People, kind of the last hurrah, which normally happens, is people get concentrated. And here you can see the concentration in mega caps are more extreme than ever. When you look at some of the levels, that's an interesting one in general, when you look at kind of where things are. And then when you look at it slightly differently on the bullish side, you can see that we're moving into, and this is the Goldman Sachs poll, sentiment poll, you can see that people are excessively bullish. So again, we're not saying that the market is going to collapse, but just looking at this in context, it might be a good spot after a hell of a run. I think this is I think we're negative now, but I think this was up until today, the 12th or 13th day of being positive. So again, that's a strong run here. Earnings revisions, the breath has turned lower recently, now negative once again as earnings revisions come down. Earnings revision, the breath of the 2 weeks rate of change. Again, you're seeing companies take down earnings. A lot of them are talking margin compression, price costs, prices elevated in general. June retail inventories were up, as we've been talking about. They came in at 0.7 versus the estimate of 0.4. Wholesale inventories came in at negative 0.3 versus the estimate of negative 0.1. So here you can see retail less buying, less activity, putting more into inventory, which means that they're not going to order as much from wholesale, or they're recognizing from wholesale into merchant wholesale into the retail. And that's where you're seeing some of these, the struggle here. And that's something that we think is going to continue. June durable good orders came in at positive 4.7% versus 1.3%. Again, that's a nice bump. And one of the things that we talked about previously is you can only not order for so long because you still need inventory, you still need product, and you can see that they're trying to manage inventories because there was such that whiplash, or the bullwhip as everyone was talking about. And now you're going to see some of that in general, and that's where we do see those new orders kind of curtailing a bit. But it's good to see in terms of trying to maintain some semblance of balance. And then in year-on-year terms, headline orders reaccelerated, so that's a net positive. Personal spending, when you look at the 2Q 2023, was the strongest since Q1. However, the housing drag on GDP has faded. Residential investment dragged only negative 0.16 from GDP, which was same as drag from the Q1. So you're starting to see a little bit of that balancing act where we do see the personal spending, domestic spending coming down. But again, housing, that the big impacts are starting to kind of level off. We do see a bit of a reacceleration to the downside, but not a huge one. It's not like we're going to see this collapse like we did in 2008. It's just going to be something that the Fed needs to see, is going to be some of those housing prices reversing lower. Big tech and real yields. It's, as you can see, the four horsemen there. And it's interesting because, coming full circle, the new indexes have fewer holdings just because the weightings are so extreme. And usually that leads to concentration risk, which is a bigger problem especially when things move down. But then when you look at the Fed, easing financial conditions. So financial conditions are getting more stringent globally speaking, but in the US, they're actually getting a little bit easier. And that's something where people are starting to price in, okay, we know where rates are. And it's not to say that the Fed wants to kind of shake that up a bit, but they don't want rates to get too easy. So we do think this is a bit more of a movement for, well, let's see what we can do on tightening some of those financial conditions. And wage inflation continues to be a big problem. And that's something where the Fed won't actually come out and say it, obviously, but you need to see some of that come back down. And you need to see some of that. And the way to do that is raising rates, making it more expensive to borrow and finance some of these individuals, and trying to bring some of that core service inflation down, which is getting pinned higher based on some of those hourly wages with the U.S. core inflation front. And that's why when you look at what is happening on the Fed balance sheet, again, recycling from before, this is why they want to look at this and say, okay, well, we still have room here to do a little bit more to get things where we feel comfortable letting them sit for the next, let's call it 12 months. Which is why when you look at some of these proxies, the looking ahead meeting this week, another rate hike is there, which happened. The output price component of the S&P Global has stabilized, and it's stabilized higher. When you go back to 2007, you can see that we're not where they'd like us to be at this point. And instead of it continuing to going down, you're actually seeing it flatline, which is what happened in the 70s. You saw things flatline in the 70s. You saw some of the stabilization. And the Fed thought, oh, well, we've made enough progress, let's start cutting rates. And then you had inflation gun. This is where you're going to see people say, or them step back and say, well, we need to make sure that we're on the right trajectory and this is really dropping where it needs to, and we're just not there yet. Then again, looking at sentiment, we're at very bullish levels. Again, kind of something to consider when you're looking at some of the different pieces. All the while, that consumer sentiment that's split. Conference Board had a nice bounce. University of Michigan, same thing. And this is, again, on the positive side because stock prices are up. Things are looking a bit better from that level. So typically, obviously, the leading index looks at other things, but the stock price is a part of it. For how people feel, it's what is their 401k doing? How are things looking? And as they feel better, well, that's when you're going to see some of this bounce. And as you can look at some of the contributions, you can see future businesses is still negative. When you look at future income is still negative, but present employment, jobs are still there. Again, another kind of point where the Fed looking at this and saying, well, jobs are still high. Should we really, is there enough room to do one more? And the short answer in our opinion is yes. Conference Board this is looking at the index. It went up to 117 versus the estimate of 112. Expectations at 88.3 versus the prior of 80. Present situation 160 versus 155. Again, nice bounce. Stocks in the blue side seem to be pricing in a significant rebound in the leading economic index from as a gap has grown to be incredibly wide in terms of where things are. Again, we don't see a big bounce, which is why we do think there's a bit of exuberance in the stock market, which will start to come down because the number of consecutive months of monthly leading indicator declines is now at 15. And we've only seen that in 2 other recessions going back to the 1960s to give you an idea of just how strong some of these problems are. When you look at the underlying, and as we showed the components, it's going to be difficult to shake that. A decline for the Conference Board leading economic index in June brought the max drawdown to 9.9%, going back to 1960. Index has never seen this magnitude of decline without already being in a recession. So again, kind of that other side of it. Per June update for the Conference Board Consumer Economic Index of respondents expected worse business conditions in the next 6 months fell to the 2-year low. So people actually expect things to get a bit better. So again, this the kind of that counterpoint, which is why it's bad, but not terrible. And in some areas it's pretty good, but not great. So again, you're getting back to this point of kind of that really low, kind of heavy growth, either slight decline without much reprieve going forward. Conference Board expectations index advanced 1 quarter, real consumption. We do see that rolling a bit because we see real consumption leading this lower like it has in previous cycles. And then the current conditions, again, sitting at those levels. While when we look at childcare, this was a fun chart, just wanted to throw in, where annual childcare costs in the U.S. Went from $9,400 to $10,600. Now, some of you are looking at this and saying, I want that $10,600 because that is cheap. For someone in New York, I can say $10,600 is cheap. For some people, that wouldn't even cover 3 months, let alone 12 months. So again, there's a lot of pricing in that, and that's something that's going to continue to weigh on the consumer as we go forward, and just wanted to drop that in. So in the next segment, we're going to go deeper into some of the other key pieces, especially when we look at some of the leading indicators and some of the economic indicators as we go into the end of Q3.